Thank you very much, and good morning, everyone. And it is indeed a pleasure to be part of the CEDA EPO roadshow once again. The good news, what I'm going to say, is pretty much what I said last year, so we should be able to deal with those questions pretty easily. Now, one of Paul Keating's economic advisors tells this story about how they were sitting around in his office one day, and there was this sound of a twig snapping. And what it turned out was it was actually the economy that was buckling under the weight of the 17% cash rate that the Reserve Bank had just put in place at the time. And of course, it was just before the recession that we had to have. And I would say, looking at where we are today, the shift from sort of reasonably positive views about the Australian economic story only a couple of months ago to the pessimism that we see now has a lot of the same hallmarks. So the questions that economists have to answer at the moment, I think, is, well, has that economic twig snapped again? Is the pessimism that we're seeing at the moment about the economic outlook actually justified? Well, of course, the recession we had to have was actually the last time we had a recession in Australia. And as we've heard earlier on, we've now comfortably into our 28th year of economic expansion. And to be honest, if I'd spent the last 28 years on Mars and just flown in this morning and you gave me an update on how the economic data looks right now, well, you'd probably show me a chart like this one. And what it shows you in those sort of key economic indicators, well, GDP growth, it's running along at around about 2.75% right now. And that's what we regard as kind of normal for Australia, trend growth, if you like. That growth has been enough to push the unemployment rate down to 5%. And that's what the experts tell us is equivalent to full employment for the Australian economy. Now, we're starting to see wages respond to that mix slowly, but there is a response there coming through. We've seen higher commodity prices starting to generate income for the Australian economy again. The budget deficit shrinking at a rate of knots on the back of that income flow, and it's been enough certainly to see the ratings agencies decide that we're a pretty safe AAA rating after all. And of course, we do have some policy space to do something if something goes wrong in the economy. I mean, all these things should be seen as a good result, and certainly a bit at odds with the pessimism that we are seeing. Nevertheless, that pessimism has lifted, and what we're seeing is just an indication of that, I suppose, is that measures of business confidence, the blue line there, has dropped a long way. And the green line, consumer confidence, well, it's up, it's down, it's become very volatile, I think, reflecting some of the uncertainties that people now perceive about the outlook for the year ahead. So what's driving this pessimism? Well, I think there's really two broad themes that are playing out here at the moment. Clearly, the global economic backdrop has become a lot more certain. There's any number of issues playing out there that are of concern to business, of concern to consumers and policymakers as well. So we are seeing trade war tensions still playing out at the moment. There is the mess that is Brexit still playing out as well. We've seen the Chinese economy slow. There's any number of geopolitical issues in play that could upset us as well, and the list goes on. And of course, there's also some downside risks to the economic story, the domestic economic story. And they're largely centred around the consumer at a time of very high debt levels, weak wages growth, and that kind of uncertainty that we're seeing right now. Nevertheless, we think the best guess is the Australian economy will still turn in some decent economic outcomes over the next year. Policymakers have responded to how these risks are shifting, though, and what we've seen in Australia and elsewhere is the guidance on where interest rates are likely to go this year has changed quite a bit. And you've all heard of the two-handed economist. Well, what we've also seen is the return of the two-handed central banker in recent times. So I've looked at the Australia's case, for example. We've heard the Governor of the Reserve Bank say last week, and he's repeating it this morning as well, that interest rates in Australia could go up or they could go down, which probably covers most possibilities. And I'm happy to put out a forecast like that as well. So certainly a very even-handed approach. What to watch? Well, the governor's made it very clear that the Australian labour market is the key to which direction interest rates ultimately go. And of course, we saw some very encouraging growth in the employment numbers that were published yesterday. Nevertheless, it's all about the balance of risks and how those risks change. And it's fair to see why people are concerned about the global backdrop. because we are moving from an environment where we've had a nice couple of years of synchronised global growth to something that's now a lot more uneven. And what you can see, and I've just picked a few examples on the chart here. Well, the first chart, it's an economic surprise index. So whenever the line's below zero, it means that economic data globally is printing weaker than people had expected to see, and that's clearly been the case. So the economy has slowed, there's no doubt about that. The policy backdrop has become uncertain. As I say, a lot of central banks have moved to this idea, well, rates may go up or down, we're not quite sure. And so we've seen measures of global policy uncertainty. The middle panel there reach essentially what have been record highs. So a lot of uncertainty about how that part of the story plays out. Of course, in the back of all of that, we've seen financial market volatility lift as well. But the point I'd make, though, from an Australian economic perspective, is we yet to see any kind of real negative impact on that coming through in the indicators for Australia. And the final panel on that chart shows you one of the Australian business surveys, something called the Purchasing Managers Index. This is a survey that the Commonwealth Bank actually sponsors. And that panel actually shows you the response about export orders. And the way to read this chart, anything above 50 indicates expansion. That's what we're seeing right now. So we haven't seen an uncertain global backdrop dampen the kind of export response that we're seeing right now. If I turn back to the domestic side of the growth equation, one of the reasons that the pessimism about the outlook, I think, looks overdone is that a fair amount of the growth story is actually guaranteed, in a sense, by the nature of the underlying drivers. And again, I've just picked a few examples in the set of charts here. A couple of months ago, Australia became the biggest exporter of LNG in the world. So that payoff from all those huge LNG plants that we built over the previous 4 or 5 years is now coming through. And as you can see on the first panel there, more of that to come. It's guaranteed growth because we've already sold that gas, we've got to produce it and deliver it. If we move on to the middle panel, in a lot of states around Australia, there are now major infrastructure spending booms underway, and most of it's going into multi-year transport-related projects that have started. Because they've started, they go through to completion. It's going to be an important source of growth over the next couple of years in many states. And finally, the panel on the left-hand, or the right-hand side there rather, looking at some of the Asian income and demographic numbers. Well, what we can say about Asia is for the first time that per capita income there is above the global average. And if you multiply that by the 3.5 billion people in Asia, then you've got a very powerful spending driver that's reshaping parts of the Australian economic story. And you can see it in things like the tourism and education booms that we're experiencing right now. Another caution against excessive pessimism, I think, is that some of the risks I would have talked about this time last year do look to have receded. And again, just a couple of graphical examples here. So, as I've mentioned, we have seen a bit of a pickup in wages growth. It's pretty modest, but we do finally appear to be heading in the right direction that will help alleviate some of the economic risks that do exist in the household part of the Australian story. What I would have also said last year is that one of the missing links in the recovery we were seeing then was just the lack of capex by the non-mining part of the Australian economy. I could have rattled off a whole list of positive reasons why business capex should be lifting, but it wasn't happening. But as you can see on the chart on the right-hand side here, the last year, we've seen a pretty decent lift in that part of the story come through, and with all the surveys saying there's more of that to come in 2019. It's when we come to the household part of the story, I think, and what it means for consumer spending. That is where the real risks in the economic story now lie. Now, one sense, there's nothing really new here. We've worried about very high levels of household debt since last century. We've worried about an overvalued Australian housing market since at least 2004. We've been concerned about weak wages growth for the last 3 or 4 years, and while house prices are now falling, the reality is that's also been underway for over a year. So there's not a lot that's new in a sense, but what I think is new is that we're starting to see a reaction from the measures that we took to try and fix some financial stability risks a couple of years ago, and we've been largely successful in fixing those risks, but we've created other risks in different parts of the story. So one of the things the regulators were concerned about was too much investor activity going into the housing market, too much interest-only lending going on. So regulations were put in place to reduce those risks. And the banks responded, and as I said, that approach has been very successful. This chart here, it's looking at housing credit or housing debt, if you prefer to think about it that way, and you can see there's been a significant drop back in the amount of that debt that's interest only, and a significant pullback in the amount of that debt that's sitting in the hands of investors. We've achieved what the regulators want, but how have we achieved this? Well, a lot of people with interest-only loans now have principal and interest loans, and what they're discovering is that their repayments are going up by 30 to 40% when they convert. Now, of course, there's no way your income is going to kind of compensate for that sort of increase, and to the extent that you pay your mortgage first, it just means that you've reduced the amount that could be spent elsewhere in the economy. So we've created a new downside risk for the consumer spending part of the story. And we can see some of the impact coming through in some surveys the Commonwealth Bank does of its customer base. And I picked out some of the high-level results here. This is a survey we do of each month of about 2.5 million households who are CBA customers. And what we can see, just to pick one example, the green line on the chart there towards the end, you can see there's been a pullback in the consumer spending that group is doing, partly in response, we think, to these changes that have occurred for financial stability reasons. What it also shows, of course, the red line is courtesy of falling house prices. Household wealth in Australia is now declining as well. And again, if you think about the house price story, again, I think that was partly a reflection of these regulations that were put in place. Now, if we take a significant chunk of demand out of the Australian housing market, that is investors, then not surprisingly, you're going to see supply adjust. There was a very interesting chart here that I've borrowed from the Reserve Bank, and what it shows you is what's happening with house prices in areas that are dominated by investor activity, and that's the pink line on the chart, and areas that are dominated mainly by owner-occupiers, the blue line there. And you can see there's an increasing gap that's opened up between those two lines as those various regulations were put in place. Now, the good news in a sense is if house prices are falling because of regulation, it means there isn't some huge imbalance in the Australian housing market that's going to drive this 30 or 40% collapse in prices that some people want to forecast. Nonetheless, though, once prices start falling, it does generate its own momentum. So why buy today if it's going to be cheaper tomorrow? Negative gearing doesn't work when prices are falling, for example. So there's plenty of reasons to think that we haven't seen the bottom in the house price story yet, and that we're going to see further falls in household wealth on the back of that. There are some offsets starting to come through. That demand will return to the market. The point I wanted to make in this chart is I'm sure everybody in this room is aware. Biggest price falls are in Sydney and Melbourne. The rest of Australia, we haven't seen anything near the sort of adjustments that have occurred here. But of course, these are the two states that had the biggest run-up in prices, but also the two states where the majority of population growth is concentrated. So we're adding 125,000 people a year to Melbourne, 100,000 to Sydney. That injection of demand ultimately stabilises prices, even if we aren't there just yet. And it has to be said, most of the leading indicators about where prices are going are pointing to the further falls, and I've just picked out a couple of those on this set of charts here. So the one on the left, the purple-coloured line there, shows you what's happening with housing lending. It's still falling. As long as that's happening, you have to expect that prices will keep moving lower. Perhaps the one positive sign I can show you is the chart on the right, where the red line there shows you what's happening with the hit rate on the home loan part of the CBA website. Now, it probably tells you something about what economists like to do in their spare time, I suppose, but the point is that that hit rate has stabilised, and typically when you get that stabilisation, within a few months or so, you start to see house price momentum, the blue line on that particular chart, move in the same direction. So it's tentative, but there are some encouraging signs there. Now, this is all fine. I could say demand's coming back in and that'll stabilise prices. But in the end, if you can't get a loan, then it doesn't really matter about the demand side. So there's a lot of debate in Australia right now about the risks that might come from a credit crunch if those lending taps were turned off in a permanent way. But again, when I look at the sort of data that we can extract from CBA's business, it's hard to see too much support for that line of argument. And I've picked out some of these indicators here. I'll perhaps just mention the first panel on the chart on the left-hand side here. What it shows you is what's happening with the home loan approval rate. So what percentage of home loan applications actually go through to approval and get funded. Now, the line's up and down a little bit, but it's basically a flat trend. So there's been no pullback in that approval rate. And certainly if banks weren't or were reluctant to lend, then a lot of those loan applications wouldn't be going through. So I think that is one very interesting indication of the lack of credit crunch, despite some of the arguments you see. Now, I have referred just a few times to falling wealth and how that process probably has further to run until house prices stabilise. So it does raise the possibility of what economists like to call a negative wealth effect. And by that I mean is that quite often when people's wealth goes down, they want to rebuild that wealth, and the only way they can do that is by increasing their savings, and again with a negative message there for the consumer part of the story. And there are some indications that there is a negative wealth effect underway, and one of the charts I'm watching pretty closely at the moment is this one. Shows you what's happening with various components of consumer lending. And some of those components have got off the edge of the proverbial cliff in this period where house prices are falling. And certainly it's a significant risk issue again when you're thinking about the outlook. What would help? Well, pretty clearly a pick up in wages growth would help. We're starting to see some of that. And we have heard policymakers, as we heard earlier on, the Governor of the Reserve Bank himself has said it's a good idea for everybody to go back to work and ask for a pay rise. So on the economy's behalf, please try that when you're finished here today. But the other thing I think would help would be tax cuts. It's the other way that we can increase household spending power in a pretty direct sense, and they do appear to be coming as well, and probably bigger than the ones that are actually on there in the government's agenda right now. Now, I've focused on the risks today because in the end that will determine which direction the Australian economy is going or will go. But hopefully I've given you enough of a taste here to say that it's not all bad news, and the gloom that we're seeing at the moment probably is overdone when you're thinking about the economic story. I'll stop at that point and thank you very much for your time today.